This is the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. We interview industry experts to unlock key information that will help young professionals break into the multifamily world in order to create long-term and short-term wealth. If you enjoyed the show, please head over to iTunes and leave a rating and written review so we can reach more listeners.
Thank you for joining us on today's episode of the Millennials in Multifamily podcast. I'm your host, John Stober, with my co-host, Fritz Ritter. And today we have Kyleighs Marcotte on to talk about how he acquired his first 100 units before he was even 21 years old. Realizing that the medical degree he was pursuing would only strap him with hundreds of thousands of dollars in debt, Kyle dropped out of college to pursue multifamily real estate full-time. Through sheer grit and determination, Kyle found a sponsor that he could add value to, and thus was able to get into his first deal. From that point on, Kyle was no longer viewed as the kid trying to make it in the big leagues, and everything started to snowball for him. Thanks so much for joining us on today's episode of the Millennials in Multifamily podcast. Could you just go a little bit more into your background and tell our listeners how you got into multifamily real estate at such a young age?
Yeah, of course. So I was a student at UC Davis. I was actually playing soccer there as well. So I was studying pre-med and playing soccer and just spending, very many hours of my day, almost 20 hours a day, doing things for other people and kind of having no control over my time and where I was going to be. So I started to realize that going forward in the future, that was probably not going to be something that was going to make me satisfied. I was already deeply unhappy with the circumstance I was in. And I could see that if I had a job, the boss would be similar to the teachers and the way I felt about them and similar to the way I felt about my coach and things like that. So I realized that I wasn't going to be a very good employee and that I had to figure out some way to be independent of my time and to start to scale out of something and potentially get some passive income. And naturally, I read Rich Dad Poor Dad, and that kind of opened my mind and showed me that real estate's a great vehicle for that sort of passive income. And not to say passive in the sense that you don't have to work for it, but passive in the sense that it's going to roll in on a continual basis regardless of your time once you get that set up, obviously. But I started to look into real estate and single family and, developed a wholesaling business out of my dorm room, but then realized again, I'd given myself a job. All the reach out, all the direct mail was taking a lot of time. So then I found multifamily. I invested in an education group called Jake and Gino. I met a couple members in there and ended up doing a 107 unit deal in Louisville and a 12 unit deal in Atlanta in the first 6 to 8 months. So it was really quick turnaround, but dropping out of school to pursue that getting a deal was a really stressful time. And I had to do quite a bit of things in order to get myself in a position where I could be, getting in big deals like that. So, it was definitely a risky endeavor, but I definitely don't regret looking back.
Man, I wish I had that epiphany when I was in college. I am in that boat right now with, my employer. Could you just tell us a little bit more about those first two deals, the 12 unit and the 107 unit? You said you were in the Jake and Gino coaching program. What types of roles did you fill out on those teams, and how did you find ways to add value to the other sponsors in those deals?
So primarily my role has been a capital raiser, and the process that I went to actually start raising capital was I didn't actually grow up wealthy or have a family or network or anything like that. I raised money from the Sacramento area near my college, UC Davis. So I became a speaker at a local meetup. Neil Bow was actually the host, and I went to the meetup the first time. And I was just a kid there, and I introduced myself. I said where I found his meetup on Facebook or however I found at meetup.com, and gave him some marketing feedback, which was adding value. And then the second time I brought my roommate and told him like, hey, I'm bringing people to your meetup. I've been speaking good about it in public, positive reviews, another add value. And then the third time I came, I asked if I could check people in and do some of the sign-in stuff and do some of the, the very, clean up afterwards, some basic stuff, add value that way. And then I did that for weeks and weeks and weeks. Started to build that relationship and asked just briefly at the end of one of the meetups, hey, can I speak on stage for 10 to 15 minutes about multifamily? Because it was predominantly a multifamily meetup, but there was still some single family flippers, as there usually is at local meetups. And I was like, can I just speak about multifamily? And as soon as I got up on stage and held the mic, I was immediately looked at as an expert rather than this 20-year-old kid who'd been coming and was kind of just in the back peanut gallery. So I think that's a super valuable thing, is to get yourself in a position of being an expert, regardless of your age. People do take you very seriously when you're in a position of power like that. And not to say that sitting on a meetup stage is a very powerful position, but it's more powerful than being in the peanut gallery. So that's a great thing. And then the 107 unit deal, just to go into it a little bit, it was actually, we bought it thinking it was 106. And then there was a down unit fully plumbed and fully ready to go. It just had storage in it. So So we moved the storage, cleaned it out, did a little renovation. And then we ended up having another income producing unit. So it was a huge value add. And then the last part of that was they were paying the property manager who was a relative almost double the market rate. So he was almost making $90K a year to be an on-site manager. So we were like, that's got to go day one. You know what I mean? Like, dude, that's a crazy salary, dude. You're like first year investment banker. What are you doing? You know what I mean?
Yeah.
But you're a property manager. So the market rate's somewhere in that like 35 to 45 range. So we immediately cut that day one. So, it was a huge value add there too. Just at, day one, cutting that expenses, it's immediately going in your pocket. So those were just two of the huge parts of the 107 unit.
Kyle, I loved how you said that you just immediately tried to find ways to add value to Neil Bawa's group just by, checking people in, cleaning up afterwards, just doing little things to add value to those people, working for free. It seems, it seems a lot of success stories have that working for free stuff where they're just constantly like, hey, you show me and I'll work it out. So, being 21 and raising a lot of this money, you got to get some funny looks. How has it been for you on the capital raising side? I mean, I know at the meetup it may be great because you're viewed as the expert, but outside of that, how's that working for you?
Yeah, so the meetup part, it only gets you the first meeting. And then from there, you have to actually show that you have some knowledge, show that you understand the lingo and that you're mature enough to handle something like this. Because at the end of the day, you're a steward for their money, right? It's not just real estate. It's not just knowing how to underwrite or knowing how the business plan is going to work out. It's actually having the cojones, I guess is the only way I could put it, to actually be putting people's money on your back and promising them that you're going to make it back and then plus some percentage, which is, you're providing them a return as well. It's not like you're just holding their money for free. You have to actually make more money, and you have to execute the business plan despite things that happen like what we're in right now, where, people can get laid off, your income can drop 30%. Are you, underwriting conservatively and making sure that your debt coverage is enough buffer there? So we try not to buy below 1.35 or 1.3 on DSCR, just because if things like this do happen and they're out of your control, and you hate to be the guy who, when you can't do anything about losing everyone else's money, that's probably a lot worse than if you were to make the mistake yourself. Like, I'd rather go out on my own mistake than something like this. So it's always important to underwrite very conservatively and talk about that when you're meeting with these people. But for my age, the biggest roadblock is, getting someone to sign you a check that size. They have to know that you're going to work extremely hard because you don't have the experience. And their first question is going to be, have you done this before? And your answer is going to be no. If you're for me, it was no, I have not done this before. And they were like, well, why would I give you my money? And I just look back at them, and every time I would say the same thing: I will work harder than anyone else you'll ever give your money to. You can give your money to the 40-year-old guy who's done 100 deals, but he's not going to work like I'm going to work. Like this, I just left my school. I just left my soccer scholarship. This is all I got. I got no backup plan. I will literally do whatever it takes, and like freaky work ethic with you. So that's kind of something that I think sold a couple people, because they were like, okay, I see this kid's drive. I want to give him a chance. It's only, X percentage of my wealth. So let's just give it a shot. And I think it's really just being honest and transparent and not overselling yourself, just meet them where you are.
So you said a term, DSCR. Could you just explain to us what that means?
Yeah. So the debt coverage ratio, or debt service coverage ratio, is I believe the ratio from your income to the actual debt service that you're going to pay the bank. So your mortgage. So if it was a 1.3 ratio, you would have 30% more income than your mortgage. Okay.
So for every $1,300 of net operating income, you pay $1,000 to the lender.
Yes.
Okay. So you're obviously an extremely driven, ambitious person. So your role was primarily raising capital with these deals. Now you're living, 3,000 miles away from these properties, though, and no one's allowed to leave their homes because we're going through the coronavirus right now. What are you doing to currently add value to these deals?
Well, right now we're letting everybody know that how are you going to be able to pay this rent? Are you going to have opportunities to? And we're letting people know some of the job opportunities in the local market that they can apply for if they have lost their job, which is huge. A lot of Krogers and Walmarts are actually desperately in need for employees right now. So if you are a lower income individual who's making a certain amount of money per month, and because we have working class housing, it's not a class of housing. It's going to be people with blue collar jobs, and Kroger might be, a horizontal move, not a downward move for them. So we're just trying to make them aware of those opportunities if they have lost their job. And we're taking away late fees for this month and doing some other things like that. And And we have on the 12 unit in Atlanta, we actually gave care packages to the tenants because there's only 12 of them. So it's very easy to get out and actually give them, food, and we get bread, peanut butter, jelly, some other food for a couple of days, just for some of the people who we knew were more struggling than others. And then, just making sure that because this is actually not necessarily an obstacle, right? It's actually a great opportunity, especially if you bought with room. So we bought with room, and we know that we're going to be able to sustain an income drop of around 30 to 40%, which is around probably what will happen in the next 2 months. Not to have a crystal ball, but it's going to be somewhere in that ballpark. Mm-hmm. And so we know that this is actually now an opportunity to create a bigger bond with our tenants, because everyone's in a position right now where we're not seeing other people, and we're a little bit stressed out. Everyone's scared. So if you can connect and take this opportunity to actually form a bond, maybe, give care packages or tell them there's not going to be late fees, or, hey, we actually found a new job for you. So just then people are like, oh, these guys care. They're not just here for my check. They're not going to evict me. You know what I mean?
Right.
So that's actually can be a huge opportunity if you look at it that way.
Absolutely. And I think you guys it sounds like you're definitely going above and beyond for your tenants. I've never heard of anyone buying care packages for them. Yeah.
You got to do it, man. Because it's how you, exactly. You got to set yourself apart as well. People want to live in our places now because they know that we're going to be doing things like that rather than just, you didn't pay, get out. Don't care if there's a pandemic, you're done. That's ridiculous.
So when you're talking about a 30% drop in income, though, how did you prepare for that on the front end in your underwriting?
So typically it's things like not expecting massive rent bumps on your assumptions. I think that a lot of people will say, for example, in Austin, Texas, where I live right now and where we're invested, it's typically a 5% increase on average for the last 10 years, but we're not underwriting a 5% increase because that doesn't trend with the national average, and that's not historically accurate. It's historically accurate for the massive boom in Austin. If you've been following the Austin boom, 5% makes sense for this anomaly. But we're not going to underwrite at that level. We're going to go back to the national average, somewhere around 2.5 to 3. Our expense increase is going to be somewhere from 3 to 4%, even though you could argue the national average is somewhere around 2.2, 2.5. So we're being conservative with our projections going forward, number one. And then our reversion cap's always going to be higher instead of lower. So sometimes you'll see people buy at a 5 cap and underwrite that they're going to sell at a 4 cap. That's anticipating the market's going to trend with your property, which is not likely, and also is not what's actually materialized for us. So you've seen that the market's actually going to probably cap rates are most likely going to expand and then go higher. And we've predicted that as well. So understanding that rent growth is going to be minimal, that we're going to add quite a bit of value. Number one, so we're going to raise rents quite a bit, cut expenses quite a bit. And then the property's not going to get the benefit of a market swing, right? So we're predicting the market's going to be flat or negative, and then we're adding a lot of value. So we're going to make sure it performs better than we're purchasing at, and we're predicting a flat growth, or negative growth. So that's kind of how you would underwrite for negative situations like that.
Mm-hmm. So with you underwriting for, you're increasing revenue, you're adding expenses. How were you able to identify these opportunities, or was this mostly your partners and then you're just using this as a learning experience for yourself going forward?
So my partner Eli identified the 107 unit, and my partner Nick, my new partner Nick, has identified the 90 unit in Austin that we're under contract on. And I definitely do help out with the business plan and do understand the underwriting process, but my role is always going to be predominantly, I believe, raising capital, just because that's where my skill set is. Mm-hmm. But I mean, my partner Eli, on the first deal I did, he was an actuary for Allianz, so he's really very analytical guy, taught me quite a bit about underwriting. So moving forward now, I have a much bigger role in the newer deals that I'm doing with the underwriting aspect because I've learned so much from Eli. So my role's definitely expanded, but yeah, it definitely started off with me mainly just getting experience and raising the capital.
Mm-hmm. And then so with you getting the 12 unit and the 107 unit, now you have this 90 unit in Austin. I mean, how have things changed since you got those first 2 units? It sounds like you're just on an absolute roll and things are really starting to snowball.
They definitely are starting to snowball in the sense that, now when I reach out to a broker, I can say I have a portfolio of 119 units, I'm 21 and yada, yada, yada. It's much easier to have that introductory email rather than, hey man, I'm 20. I have no deals. I have no experience. I can't raise any money. I've never done it. You know what I mean? So you start to get a little bit of credibility with brokers. It just kind of lowers that barrier of entry. People will take you more seriously and return your calls slightly more. And then also I have a bigger investor list that I can actually now honestly add value, and people know that since they've seen, me go on podcasts and they know my unit count and things like that. They know my portfolio, my experience. So they're like, okay, this guy probably can actually add value rather than, okay, we're taking a huge risk on this kid who's still in college. You know what I mean? So that's definitely opened up my opportunities for sure. And I still hit the pavement just as hard as I was when I didn't have any of this. So it's kind of just now I'm not losing as many of the opportunities as I was when I had no experience, because everyone was like, that's a really nice kid, but yeah, talk to me in, 2 years or 3 years,
Mm-hmm.
So now I don't have to get that shoe away. I can kind of come in to most people who I reach out to.
So Kyle, do you kind of see your age now more as an advantage? I mean, that introductory email, hey, I have a portfolio of 119 units and I'm 21. Here's my phone number. Give me a call. That's a pretty good introductory email.
Yeah, I definitely think that that's how a lot of things work, is where your greatest weakness ends up being your greatest strength when you really lean into it. I've found that in a lot of areas of my life, and this is just another example of that, where that was the biggest thing holding me back, right? It was everyone telling me I was too young, and then my mindset of, the limited perspective that you have as a 20-year-old is definitely hindering. You know what I mean? Like, you can't see very far into the future. A decade ago, you were 10. So how can you think 10? You know what I mean? So how can you
elementary school?
Exactly. So how can you think 10 years in the future, which a lot of these deals are on a 5 to 7 year scope? 5 to 7 years ago, you were so young. You were 13 or 15 or 10, so it's like the perspective is just not there. You don't even have that skill yet. So that's a huge thing. But then once you start to gain a little bit of this credibility snowball, then you immediately are kind of grouped into a whiz kid category, which is either, you could argue not justified, but like it definitely, I'll take it, right? You know what I mean? I'll take it. And I'll try to use the credibility, right? So, but that has definitely now become a huge strength. I mean, I'm getting on podcasts like this. When, if I was 35 or 40, people probably wouldn't think the tagline was as interesting, or they maybe wouldn't listen to the podcast. So it's definitely ended up helping me out a lot.
Yeah, for sure. I can definitely see that. You're definitely the youngest syndicator I've ever met or heard of. So it definitely
Awesome.
raises the
Kudos,
eyebrows,
man.
but it's awesome too. So with you, I want to get back to your management though, because you're buying all these properties in different markets. Does that pose any challenges from a logistical perspective in building out your management systems?
Yeah, I mean, it definitely it is a more logistically challenging endeavor than it would be if they were all in the same market, for sure. But it's still much easier than you'd think. Honestly, like each property probably takes about a 1 hour call each week. And we have, we have metrics that they need to hit. We have budgets, we have vacancy reports and things like that. So it really does take somewhere between an hour to 90 minutes per property per week.
Mm-hmm.
So it's, again, like, yes, it is 3 calls instead of maybe 1 call, which would be ideal. But at the end of the day, it's still only 3 hours of the week, around 3 hours of the week, where you're kind of overseeing things. Then obviously there's the fires that come up, and that takes a little bit more time. And those are in 3 different places, but you'd probably still have those even if they were in the same market. So the real logistical error comes down to, sometimes scheduling contractors if we have things to do, but usually that'll be through the property management company anyways, unless it's a larger expense. So typically, logistics are pretty great in multifamily. That's one of the reasons why I joined the business, was because of the fact that you can scale out so much, and that on-site guy is there almost every day. So it's pretty much his job to be dealing with all those logistics, and my job is just to be checking up on him on a weekly basis.
Mm-hmm. And could you dive a little bit deeper into those reports and those KPIs that you were talking about that you go over with your property management company? I mean, what's important for you and your company?
Yeah, number one is not going over budget, right? They have to understand what we can spend on a monthly basis. And if there's a damage or something like that, they have to run it by us. If it's over a certain ticket item, I believe it's $250 or $500, depending upon the property. But basically, they have to, like, every time something breaks, you can't necessarily fix it right away. We have to game plan kind of how we can allot it in the budget for the month, and how that's going to look for our pro forma, and what that's going to do to our entire projection, right? Because if the property manager doesn't understand that we have certain projections expense-wise and a certain CapEx budget on a monthly basis, then you can't just like go willy-nilly spending things or improving things that don't need to be fixed. Like if you see that the grass is not the right height, and you go and hire a landscaper for $500 that month, and we don't have it budgeted, that's a huge mistake. You know what I mean? Like we'll cut the grass next month when it's a certain, like, you don't have, that's not an urgent thing, right? That's not life or death. You don't have to go and call the landscaper because it's not in the budget. And then that skews the pro forma, and it's a 5-year pro forma. So it's like, it'll change a lot more than you think. And having them understand that, educating them in the beginning. And typically when you buy, the bigger the deal you buy, the better the property manager you'll have. So that learning curve's easier. For the 12 unit, it's much more difficult to educate someone who's typically running single family homes. But on the 107 unit, we have a very high class property management company that has 4,000 units in Louisville and understands, not to do those things. And then basically we just have, our budget, we go over it every month, and we make sure that they didn't make the mistake. And then we have, okay, where's the vacancy at and why? And then we have certain, market averages that we want to be at. And then other than that, man, it's just kind of, if there's a fire that came up, how'd you deal with it? And do we still need to deal with it, et cetera?
Mm-hmm.
So it sounds like a lot of these rules may have came from experience. Have you had any issues with property management or forming your team where they were spending CapEx items all willy-nilly?
I actually haven't had too big of an issue with any of that. I mean, very minimal things like, a couple $100 over or a couple $100 under. But typically, the Jake and Gino program does a great job of educating us and making us understand kind of how to go about the management day one, because they actually have their own management company and they kind of know how to run one. So when you go out and hire a third party, the questions to ask. They even provide sometimes a list of questions to ask and things like that. And also, I learned from one of the Michael Blanc podcasts that I listened to. He actually had a guy who wrote a management book on multifamily. I ended up reading it. It's like this bright orange book. I forget the title.
Buy it, Rent, Profit?
I might be that. Yeah, it sounds right. It's like a bright orange book. It's on Amazon. But either way, that's a great book. That guy has started a great company and then landscape company off of that company. So just kind of seeing a lot of the things like he talks about, most of the monthly numbers or things that we tell them to hit are things that I learned from that book too. So, experience is amazing and definitely the best way to learn, but you can also get pretty far with podcast books and education programs too. So don't fully shortchange yourself and think that you're, SOL because you haven't done a deal. You can definitely, if you work really hard and you make sure you can educate yourself. I mean, in 2020, dude, you can Google almost anything. Yeah. You know what I mean? So it really is, the world is in your palm. Literally, it's in your pocket most of the day and it's in your palm for a lot of the day. So it's like, you just got to look it up and take the time to do those things.
Yeah, I've always said you can either learn the easy way or the hard way, and if you're a hard way learner, you better be tough.
Exactly. Yeah.
No, but spoken like a true millennial, YouTube and Google education.
Hey, it's super true, man. People sleep on Google and YouTube, but I honestly would wager that they're maybe better than university, but who knows?
Oh, yeah. Dude, I have a buddy, just a little side note, who studied accounting in college, and he taught himself how to build a drone off of YouTube and Google.
Wow.
No engineering background. Yeah, so you can learn anything from YouTube and Google.
I've seen people come into my work and just YouTube how to replace things that they should be certified in.
Yeah, man, it's crazy. It's crazy.
Yeah,
it's the wave of the future.
But so in these markets, do you have any boots on the ground to, who can actually walk the properties and do surprise visits from the property management company, or is that just something where your team is traveling to and from the markets and doing surprise visits?
Yeah, so I do have partners on ground in Atlanta, and then Eli lives in Minnesota and goes down quarterly to the Louisville deal, and sometimes I'll go and join him as well. And now in Austin, I am boots on the ground here in Austin. So the portfolio is mainly going to shift to being predominantly in the Austin market. I grew up here. I know the market really well, and I live here. So it's very easy for things like that, like you just said, surprise visits and personal meetings and things like that. So moving forward, I think it'll be mostly in Austin just because I like the projections, especially even with coronavirus and the potential recession impending, like things like that. I think there's still such strong growth in Austin that it's going to be fine, especially if you're in the real core metro area.
Mm-hmm.
So bringing up the coronavirus, how are you and your team planning to continue to grow in this new economy that we're adapting to?
So I would 100%, again, I'm not an economist, but I'm not going to advise anyone to continue to push forward right now. We're pumping the brakes on this 90-unit deal that we're on right now. We're probably going to renegotiate the price, and it'll actually be a blessing in disguise because the T3 that we got was so-so anyways. So we were already a little bit skeptical about the price point that we were going to pay at. But now knowing that March and April and potentially the coming months, all the way maybe even to July, are going to be much lower, buying it on a T6 is going to look a lot different than the T12 that we have been looking at. So I think we're going to be able to get a much lower price point, especially with the seller not having very many options and also us being able to come back into the deal with no contingencies because we've already almost done all of our inspections. We have our reports. We have pretty much everything done. Our contingency window ends in 2 weeks. So if we can drop out of the contract with, no real negative repercussions and then come back in when this whole thing settles down and the market's a little bit more, because real estate does lag behind the stock market. So we haven't really seen the fluctuation yet. But I'm sure that we will coming up in a couple months. So if we can wait till that, I'm not sure that anyone's going to be buying at our pre-coronavirus price. So I think that now that if we can come in and everyone's going to be post-coronavirus pricing, but we're not going to be able to, but we can do it with no contingencies and close in 30 days, as opposed to other people who are going to have to do exactly what we've already done. So I think that we're actually going to be able to get it at a great price. And I would say that right now, to continue to grow your business, brokers are now in the situation's flipped. The roles have reversed, right? They've been the guys, right? They've been the pretty girl in the bar, and we've had to go up and talk to them. But now it's kind of switching, right? It's now a buyer's market. So now I've actually been getting quite a bit of texts and emails from guys who'd never respond to me, right? So now they need people to come and look at their deals and things like that. So if the more brokers you can reach out to right now, they're in a position where now they have to ask you instead of you ask them. So you are actually in a lot better position. And then also, if you can raise capital from people who are losing money in the stock market or who are liquid right now because they've played this very well and they're looking for something to invest in. I mean, real estate's going to be at a discount potentially in the next year and a half or year or half a year. So you can really take advantage of that if you grow your investor list and also your broker connections.
Yeah, I think what we could definitely start to see is any owners who bought recently and over leveraged are going to start running out of cash reserves. And when that happens, they're going to become motivated sellers. And that hasn't been the case in the last 10 years because rents just keep going up and occupancies have been at all-time highs.
I totally agree.
And I like what you said about reach out to the brokers, because I can't tell you how many emails from brokers and wholesalers I've been getting right away. I mean, I attribute a little bit to people being quarantined and staying at home, but I commented on a Facebook group probably 3 months ago about this guy who had deals in Columbus, Ohio, where we look, and I just got like 40 emails from him about all the deals that he had off market. And it's like, okay, now you want to pay attention.
Exactly.
Are you struggling to understand how to underwrite multifamily properties? Hi, I'm John Stober, and I completely understand your problem. I thought underwriting would come naturally to me due to my background in finance and accounting, but I quickly found out that there aren't a lot of resources that cover this subject. I had no idea whether what I was doing was right, wrong, or just original. I don't want you to have to pick up little nuggets here and there like I did. So I wrote an ebook called How to Analyze Big Apartment Buildings and Make Them Feel Small that puts together all the pieces of the puzzle. We're also giving away a deal analyzer with the ebook, and they're both completely free. Don't wait as long as I did to start chasing financial freedom. Go to bit.ly/underwriting ebook and get your free copy today. So has this, I guess, economic shock changed the investment returns that you're offering to your investors? Are you able to get away with something lower, like an 11, 12, 13% IRR, whereas before they were probably looking for 15, 16, 17?
I mean, it really does depend on the deal, for sure. I think that I don't think that this necessarily means you have to have lower returns. In fact, I think that in a lot of cases, if these discounts do actually happen and cap rates do expand and you end up buying at a good price, with, maybe buying on actuals will actually exist again, right? We've been buying with the room and the projection of the value that's going to be had or realized in the next couple of years of ownership. But now going back to buying on real actuals, I think that that'll actually allow you to have similar to even higher returns, especially in the cash on cash category.
Oh my God, I can't wait.
I know, right? Buying on 8 and 9 caps again. What the heck? That is going to exist. That's going to be fantastic.
Yeah, with this super cheap debt too.
Yeah, you can still get 8 or 9 caps in Detroit.
Yeah, have fun there.
Yeah, I'll pass, man.
Yeah, likewise.
So is there a reason? I mean, I know you live in Austin, but I guess what I want to know is, even with this shock coming, how hard is it to find deals in such a competitive hot market? Same thing with Atlanta. Everyone's been looking at these markets for the last 5-10 years. Everyone knows about them. So how do you stand out?
I think competitive markets are definitely difficult to stand out in, but like we spoke about earlier, the age thing has actually been a little bit of a benefit there for sure. And then also the aspect of once you do get through the initial competitive barrier of a market, then it ends up being really huge for you, because if you can be a guy that people are actually sending you deals to in these competitive markets, then you're getting access to some of the best deals in the country. So it's kind of a trade-off where up front it's really horrible and you're not going to get any deal flow and it's going to kind of suck. But then once you get through that, it's huge. And my partner Nick and Mark, who are in the Jake and Gino group as well, have over 200 units in Austin last year that they closed. So partnering up with them has given me a lot of credibility, and they have some broker connections with some deals they've closed in Austin. So, people are now sending them, this 90 unit in Austin, which is, it's a huge deal to have it in Austin as a 90 unit in North Austin. They're building a new MLS stadium in Austin, and tech companies are coming here like mad, and coronavirus isn't really affecting tech companies necessarily. And in some cases, it's actually helping them, because people are realizing that maybe we need to transition to a more online society. So I really see Austin being pretty bullish on Austin long term. I definitely think in the short term, everyone's going to feel this regardless of your market or positioning, just because of the sheer shock value of everything. But long term, I don't think that it will really impede Austin too much.
So these partners on the Austin deals, they're different than the ones on the Atlanta deals and Louisville, correct?
Yes, correct.
So as being a capital raiser, has that worked to your advantage where you can start to partner with different teams and different groups, whereas maybe if you're the asset manager or the acquisitions person, you have to go out and acquire your own deals?
Yeah, I definitely think that is a huge advantage. And now that I've found, Nick and Mark, I think it's probably going to be a more long-term situation because our personalities fit really well and our goals long-term fit really well. Because for me, I always wanted to get closer to the bigger MSAs in the country. I've always just had a philosophy that those are going to be the most, because things like this happen. And if you're in a tertiary market, you're going to feel this extremely hard. It's just, so you'd rather be in Austin where you're more insulated, or LA, which is where Mark invests. I don't have any deals with Mark in LA yet, but he invests in LA. And I mean, he's in the core of the largest city in America. So it's typically not going to be too much of an issue demand wise. And same with Austin. So I've always kind of been looking to move there. I just felt like I had to graduate to those deals. So now I feel like I've kind of moved into that space, and that's kind of where I'm focused now.
Yeah, we just spoke with a guy who buys in Jacksonville. And he was like, you know why I buy in Jacksonville? Because everyone's heard of Jacksonville.
Yeah, that's a good point.
It's like, who's heard of Jackson, Mississippi? It's like, hey.
Yeah, exactly. And then also the employment base isn't huge in some of the tertiary markets. Like, you want to have 7 to 8 employers that are huge in multiple industries that are going to be affected by different things, right? Instead of some towns, like I know Chattanooga, Tennessee, which is where I looked for a while, all they have really is the VW plant. And I don't know what something could happen to automotive. I have no idea, but that's the thing. Like you have it's a one-trick pony sort of situation. And sure, there's some other things. Like I know Amazon has a small fulfillment center out of there, but still, it's like they're mainly relying on a VW plan. And there's other cities that are examples of this where you don't have too diverse of an employment base.
So when you're in a market like Austin, though, are you really diving in deep to those employment numbers and population numbers, or do you just know, like Austin is a booming market? It has tech here. The University of Texas is based out of there, and population continues to grow.
Yeah, at first, definitely when I was, first evaluating Austin as a market, I wanted to make sure that I wasn't just being like a homer and saying that my hometown was so great. I wanted to make sure that my numbers were pretty decent, and that's just on annual year-over-year job growth and things like that, and annual income growth and some other basic, census tract data that you can look at. And yeah, Austin pretty much ticks almost every box that anyone would ever look at, even, and even some of the sub-markets, you look at crime and you just find, as you narrow down, you just try to find the best areas.
Mm-hmm.
With Austin, Texas being such a hot market, I'm sure the price per door is pretty high. Are you still targeting C-class assets, or are you kind of targeting more of the stable B- to A- assets?
We're predominantly going to be in the 1980s in Austin, just because of the build quality of some of the 70s price. The 70s build assets can be a little bit tricky in the Austin market specifically. So we're looking in the 80s mainly. And I guess those would be considered B- to B properties instead of C. But yeah, they're definitely still value add. They're not necessarily fully stabilized by any means. But yeah, that's typically what we're looking for.
So could you talk a little bit more about the build quality? What are you looking for in the type of construction when you're acquiring assets?
So we want to make sure that the wiring is up to date and that, fuse boxes in the units aren't going to be outdated. So copper wiring, things like that. We don't necessarily want to have to do those things that people don't notice, right? Because when you go and you add value and you're fixing, let's say a roof, like that doesn't necessarily raise the quality of tenants. You can't really get a rent bump from that. And we can do some cosmetic improvements that are going to make people's like day-to-day lives more valuable, and that they can see them. Because when the tenant can see and feel the improvement, then you're going to get a higher rent. But if you're doing things like plumbing, that's not going to get you more rent. It's just going to take money out of your pocket. So we look for deals that are going to have the base, foundations all squared away so that we don't have to spend money and not see a return on it.
Mm-hmm. That makes total sense too.
So Kyle, what's next for you and your team?
Honestly, probably just continuing to network with passive investors and brokers and see if we can get the deal flow going, and if we can get the investor list big enough to where when these discounts are realized and the real estate market stops lagging behind the stock market and we kind of see some of this fluctuation and cap rate expanding, then we can maybe go and buy some deals in Austin that are severely discounted that we were looking at a year ago for maybe, almost 10,000, 20,000 more a door. So if we can go and buy those properties that we already know that we can run effectively, but now we're just buying them at a 20%, 30% discount to what we were looking at a year ago, then I think it's going to be a huge opportunity for passive investors and for our company as well.
So do you see yourself staying in the role of capital raiser, or do you see yourself adding more skills with like asset management, underwriting?
I definitely do some asset management underwriting now. It's kind of a cool bond that we have as a group where we're all kind of doing different tasks. And, Mark and Nick definitely raised some capital as well. And we all kind of come together to do deals, which is really cool. But, that is something I've always kind of looked to do more of is, can I get more involved in the business plan and the asset management? Because I think that that's where the true value in real estate is, because that's where, that is the real estate of it, actually, when you think about it. So that's where I've always been trying to position myself in the most valuable role that I can find myself in. So getting more and more asset management tasks is what I'm really looking for. And that's another reason why I partnered with Mark and Nick, because they were looking for someone to come on and help more. Because, Nick is currently managing the LA portfolio that Mark has, and then they're expanding into Austin too. So they definitely need a lot of hands on deck. So we've been all kind of doing multiple tasks.
So Kyle, with growing your investor list, what kind of strategies are you doing to try and put more content out there? Being a millennial, are you utilizing social media?
Oh yeah, big time. I mean, I'm trying to be almost annoying on social media. I don't know if you guys follow me on LinkedIn, but I post almost 10 times a day on LinkedIn, and I try to post like 3 to 4 times a day on Facebook and Instagram. And LinkedIn is just, there's such a natural reach that I try to just really pump out content almost every hour. But I've recently trying to strategy out. I'm kind of getting blocked by the CAPTCHA thing on LinkedIn, but I was trying to use one of the softwares that allows you to, send those messages automatically to people when you connect with them. And then that would hopefully channel them to a webinar where we could talk about the basics of multifamily and also just some of the tax benefits of real estate investing in general, and then see if we can maybe get those people into an ecosystem where they are learning about multifamily, seeing the benefit for them personally, and then hopefully investing with us maybe longer term after we've educated them, and kind of brought them up to speed. So that's been one of the bigger social media push strategies that I've had recently. But we have a big email list that we send out to on a weekly, monthly basis, and we just keep involved with technology like that.
So I think we're very active on Facebook, but not so much on LinkedIn. What would be your number one tip to stepping up your LinkedIn game to reach passive investors?
LinkedIn's a weird one, man. But I've found after doing a lot of split tests that videos and pictures really don't get that much reach. It's kind of it's interesting. Like not every time, but most of the time, I've even posted several things where it's the same exact like post, but one's in a picture form, one's in a video form, and one's in text form. And when you do the text form with enter or a return between each line, and you break the post up into very short lines, bang bang bang, those typically get like the most reach I think I've ever gotten on a post was I put faith as an acronym, and it was finding answers in the heart. And that got like way more spread than any other thing I'd ever done. And I was like, okay, people just want to read these nice, choppy, like line by line kind of posts. And I've seen that a lot of the big guys on LinkedIn who have, a bunch more followers than I do, they typically follow the same kind of pattern as well.
So are you noticing amongst the different platforms that the investors want different things? For example, maybe on LinkedIn, you're dealing with a bunch of rich executives who want the tax advantages, whereas on Instagram, you're dealing with a younger generation who they just want to get into a deal and get the experience. Or are you seeing that it's the same type of investor on each platform?
I think that's actually a really great point, that it is definitely different people on different platforms. Instagram is a noticeably different audience than Facebook and LinkedIn. Each, I think Instagram's its own thing. It's very much younger guys and younger people. And I try to find on my Instagram contents more tailored towards educating younger people about financial independence, and financial literacy in general, because that's something that changed my life coming from a middle-class background where we just made it, spent it, no investing. That's just kind of the MO. Well, I realized that if kids can learn about this at an early age, they can change their entire family's history. They just have to know some simple stuff that's really not that complicated. It's just no one talks about it. So I want to be the guy talking about it on Instagram. And typically I get feedback from people in their 20s who want to just say like, hey man, I enjoy what you're saying. Like, you want to call for 30 minutes and just see where I'm at? And then I'll see if I can help them, maybe go from where they are currently to where they want to be and things like that. But on LinkedIn, it's a lot of, like you said, wealthier or older people asking me about the tax advantages, asking me about the returns. They're already pretty savvy investors. They've done well with their life. And they just want to maybe diversify or get some more alpha than the stock market that they're currently in, things like that.
Mm-hmm. And for everyone, what does alpha mean for everyone who doesn't know what that is?
Basically, to super simplify it, it would just say like a premium on your investment. Like if most people are thinking that you're going to get 8%, like if you were to say you would give someone 12%, then you would be getting like an alpha, right? Like I guess that's the easiest way to put it, is it's a premium, a higher return than the market.
Mm-hmm. Awesome. We all just learned something.
I did.
Yeah. No, that's awesome. And then so when you're targeting these younger professionals on Instagram, I mean, I'm assuming these people aren't passive investors. They may not have the money to invest in a syndication. So how does that provide value to your company? Or is this just a way that you like to give back to younger people?
I definitely, number one, it's like a passion thing for sure. I think long-term, I'd love to be more in the coaching role or the motivational speaking kind of role. I'd love to have a position where I can inspire young people to take action on their life, and especially in the financial literacy aspect. Because I think once you have your money figured out, you can do whatever you want with your life. It's just people don't have the money figured out, and then they get caught in the wheel and they can't get out of it. And then, they never get to follow the dream because they have to work their job to pay for their family and their kids and things like that. And then you're 40 and you have people who are dependent on you, and you can't really make these big adjustments in your life. So if I can reach out early before you have all these people dependent on you, and you can kind of pivot and take risks, then I'd love that. That would make my life extremely whole and valuable. So I'm trying to move into that space, but also just the more exposure you get as a business, if your follower count's higher, if people are engaging with your posts more, hopefully maybe you can get some more credibility from those people who are going to invest currently.
For sure. I think one of the biggest advantages we have as younger people trying to break into really anything is the no family, no obligations. For the most part, some people don't have mortgages. They maybe split a rent with roommates, no kids. It's just, if you need to work 12 hours that day and stay up till 10 at night, you can. And there's so many people that comment on certain things on Facebook, and they're just like, oh, you must not have a family. I'm like, no. I get to work when I want. That's the point.
Yeah, you got to kind of do that early, because like you said, man, when you got kids who are relying on you for food, man, like how are you going to justify leaving a job at that point? It's a huge, massive risk. So, it's not even a risk for your own life. It's a risk for people who are vulnerable and rely on you. So it's almost like you can't even do it.
Yeah, absolutely. Okay. So I think we're running close on time. So I wanted to get to the next section of our show, which we call the Fast Five. It's the same 5 questions that we ask every guest who comes on our show. And if you're ready, let's get right into it.
Yeah, let's do it.
Well, normally this question is, if you had to start all over again, you were in your early 20s, how would you do it? For you, I'm going to change that and just say, if you could have changed anything about your start, would you have done anything differently?
About last year.
Man, I don't know. I guess I'm trying to think. I think I would still do everything the same way. The cliche answer, I wouldn't be where I was today if I hadn't made some of the mistakes that I made. And so I wouldn't really change anything, honestly. I guess the one thing I'd love to reach back and tell 16-year-old Kyle is that you don't necessarily have to go to college, man. I know that everyone says that you do, and that you want to seem smart, so you want to go to this good university and study medicine, which for some reason you want to study, but you don't have to do that, man. You can just do what you really want to do, and kind of, you don't have to go to college. It doesn't make you stupid. It doesn't make you not a good person. You can still do that thing and be worthy of success. So just follow what you actually want to do. Don't go and follow the prescribed route. It's not necessary.
Mm-hmm.
Very good answer. How do you see young professionals adding the most value to experienced operators in the space?
I think it's honestly going to be, at first, just the hard sweat work that people don't necessarily want to do. And that's a lot of times reaching out to people via cold call or via, reach out email, and doing a lot of the groundwork that someone who has closed a bunch of deals is like, man, I really don't want to do that anymore. So that's kind of where you kind of slip in and add that value.
Awesome. Now, what's the biggest mistake you've made in your career thus far, and how have you since adjusted your business from that?
I think the biggest mistake was probably on the 107 unit. We actually didn't know that one of our passive investors was going to 1031 into the deal. And you can 1031 into a syndication. You just have to file a tenant in common agreement, which is a lot more paperwork, and you have to let all the other passive investors know, because now they're going to be a tenant in common on the deed, which means that they've now it's liable on them as well. So that you have to understand their background and make sure that they tick all the boxes and, understand that they're going to be on the deed, right? So it's a huge thing. And then you can tenant in common out of that once you close, but you have to into close being a TIC, which, it's a lot of paperwork. You got to have some leeway time. And we didn't really have enough. We ended up making it work, but we didn't have too much time. It was a huge crunch and a really stressful situation. And now we've altered the business to where our soft commitment form, week 1, when we send that out to passive investors, it says, where are you investing from? Is it a 1031? Is it cash? Is it your retirement account? Because again, even if it's your retirement account, your IRA, and you've self-directed, you have to have a custodian, and that takes a couple weeks too. It's not, instantaneous. So we need to know these things. And now we ask that week 1, and we follow up and we see where people are at, and we make sure that we don't end up making that mistake again.
That's a really good tip.
We need to start doing that.
Yeah, it's a really stressful situation when someone's like, yeah, I'm bringing like half the money to the deal and it's 1031 and we got 2 weeks. What are you gonna do? You know what I mean? Like you can't close without the guy. I mean, if it's not a significant amount of money, I'd say just don't even do the TIC. But if it's a lot of your money that you're bringing to the deal, man, you got to make it happen. And it's definitely not easy. So.
I can imagine that stress.
Yeah, dude, it was brutal, dude. And I was still a college dropout with no deals. So it was like, what are you going to do, man?
Of course, the first one.
Exactly.
Number 4, what's been your favorite way to incorporate technology and social media into your business?
So yeah, like I said, I post quite a few times on social media every day. And I think that has gotten me, it's gotten me on some podcasts. That's been huge for my brand as well. And, I'm going to Michael Blanc and some other bigger ones like Joe Fairless I went on last week. And that's all purely just because I DM'd them like 100 times until they responded. They didn't know who I was. I didn't do anything special. I just went on Instagram and I DM'd them like every week for a couple months, like starting in January and mid-February. They were like, all right, man, come on already. Jesus. You know what I mean? So I think that's kind of a huge way to use social media. Is just kind of be persistent, man. And people really do actually look at their DMs a lot more than you'd think, way more than they do their email. So definitely just DM people who you don't think are going to respond and see what happens.
Oh, for sure. I definitely check my DMs more than I check my email.
Exactly.
That's
check
actually
email
how we
like
got a lot of guests on here.
Okay, and last question is, what books have been most influential to you on your journey?
So Rich Dad Poor Dad for sure, but that's the typical answer. So I'll also add The Millionaire Fastlane by MJ DeMarco. I don't know if you know about that book. It's not quite as popular as Rich Dad Poor Dad, but it talks about the math of being an employee and how it just doesn't make sense. If you look at, trading, if you work 8 hours days and you need, let's say like a $2 million retirement account, if you want to live for 20 years, you want to retire for like 20 years, you need $100,000 a year. You need to get that up somehow to like 2 million. And if you work, 9 to 5 for a certain amount of years, like he just does the math in the book and it shows that you come up short based on, some of the fees in a mutual fund structure, even if you're doing that, and how you kind of have to either be an entrepreneur or an investor in some capacity. If you keep your job, that's totally fine, but you have to invest on the side. You have to live below your means and invest on the side. And he just breaks down how it's literally like mathematically impossible for you to just live like at or slightly under your means and be an employee and just hope that you're going to get there on savings. It's not going to happen.
Mm-hmm.
Yeah, I've heard good things about that book. Kyle, I wanted to add one more question just for you because you're a special case. For people who want to be in a position like you are, what kind of advice would you give them, if they are 18, 19, just in college and they're looking to do what you did?
I'd say just educate yourself like a madman. I mean, when I first learned about this, it was like this huge opening in my mind. And I just basically would wake up. Before I even dropped out officially, I stopped going to class because I would just wake up at 5 a.m., do my miracle morning, which is a thing I read about in a book. I don't know if you guys know about that, but the first hour
book.
Great book. So I started doing that at like 5 a.m. till 6 a.m. And then I would go and I would read literally from like 6 a.m. and do nothing else all day other than eat. And I would be really mad when I had to break to eat. And I would just do that until like 10 p.m., go to bed and do the same thing. And I did that for months. And I was just reading, listening to podcasts in between reading. And then even at meals, eating and listening to a podcast and even being upset when I had to go to bed because I wanted to learn about it so bad. And you don't have to be that obsessive. I'm naturally like somewhat of an obsessive guy and I've used that to my advantage, but like you definitely got to educate at a serious level and like understand that this can change your life. Like it can totally take a guy who like me, middle-class kid, mom's a yoga teacher, dad clean pools, from Central Texas, nothing special. And I can try to potentially change that whole life for my family to where we can, my kids don't have to go through what I went through as a kid and we can have plenty of money around and things like that. And it's just, if I learn something, if I just read a couple books and listen to a couple podcasts for a year, if I trade 2.5 to a year of my life, I can have 50 years of amazing, like it's really an easy trade if you just sit there and think about it. So I just got clear on that. Hey, I'm going to sacrifice 2 years of my life and I'm most likely going to have an amazing rest of my life. So let's just grind this out. And I think that if I could tell an 18-year-old to do that and tell him, hey man, it's really not going to take that long. You just have to do it. Like, you just have to trade, you have to sacrifice a little bit, but that's, I'd rather choose my sacrifice than be forced to sacrifice, which happens to a lot of people.
Yep. I'm told it's just made.
I think Gary Vee said it best. Eat shit for 2 years, eat caviar for the rest of your life.
That's a really well said way to do it, man. I should have said that.
Your roommates must have hated you in college, though.
Yeah, we definitely got into it a little bit. They were, but honestly, my roommate, like Rory, I mean, shout out if he listens to this podcast, we still are in contact, but I mean, the kid grinds very hard as well. He's an accounting major, and we would go to the gym every morning, and he played soccer with me too. So, getting a Division I athlete, you have to be kind of an obsessive person, and he definitely held me accountable to a certain extent for sure. I mean, he was definitely annoyed at times with me being up all night and coming back from meetups at 10 and then waking up at 5 and being loud. But he definitely was still a grinder. So, I mean, respect to him if he's listening.
Respect to Rory. Well, Kyle, thanks so much for joining us. Thanks so much for joining us on today's show. I know I got a ton out of this, and I'm sure a lot of other people will too. What would be the best way for people to get in contact with you if they wanted to reach out?
Probably KyleMarcotte.com. That's my website. And there's a bunch of good resources for new investors. I have, all the resources that I used for the first couple of years, podcasts, books, and things like that. And then I also have a how to raise capital guide that's super simple. It's, 6 tips basically, and it walks you through the meetup strategy that we've talked about and some of the broker reach out strategies that we've talked about. And then, you can also schedule a call from there and things like that. And then on social media, it's Kyle Marcotte 9 on Instagram, and then just Kyle Marcotte everywhere else. So yeah, check me out. I post quite a bit. So
awesome. Thank you so much.
Well, Kyle, I want to appreciate you for being on the show, man. Hopefully we'll have you back on in a couple months when you have 10,000 units.
Yeah, thank you, man. It's been great. Thank you guys for having me on.
Of course. Thank you.
Thank you.
Thank you for listening to the Millennials in Multifamily podcast, brought to you by Kronos Investment Partners. If you enjoyed the show, please leave us a rating and a written review at iTunes so that we can connect with more people. Finally, head on over to KronosInvestmentPartners.com and sign up for our newsletter so you can stay updated on everything we're doing. If you're interested in partnering with us as we find new opportunities, you can also schedule a phone call with us under the Contact Us tab at KronosInvestmentPartners.com.